Wow, even my face is red, you see.
In some ways signify how the portfolio was doing.
Yeah, same as my portfolio. Today's session is not my session. This session is for Boonsong. I think Boonsong doesn't need introduction. He has been here with us for so many episodes already. So I'll just pass the mic to Boonsong.
Hello, thank you everybody for attending this on the early Sunday morning. So let me start off by stating out front the objective and why I'm doing this. The reason would seem quite dumb to some of you because if you are atheist, I'm a really simple-minded person, and for much of my life, I live my life quite selfishly. Things changed 7 years ago. My mom had diabetes and was hospitalized, and some years later, she had type 1 as well. So recent years, I've been trying my best to help people, give some karma for my parents, especially my mom. So it's with this mindset that I approached Boon back then in 2021 December, and I shared some things. I was pretty vague back then, and I understand that. So in today's video, I try to elaborate on how I invest. I have to do it through a few case studies and followed by a Q&A. Some of you might find the returns that I make too low. For that, I can only say that it's in line with the means and methods that I used, and I'm pretty satisfied with what I had. And for those who feel that the process is extremely nerve-breaking or difficult, I'll urge you to do dollar cost averaging over index funds. Value investing is simple but not easy. You can always get the price of how a stock is doing day to day, but the value of the stock is something quite imaginary sometimes. And dollar cost averaging over index fund has always proved to be very reliable of achieving satisfactory returns. So I always envy people who DCA over index funds because sometimes the market can be extremely volatile and you can get very, very worried. But over 20 years, index funds would do pretty well. So I hope that through this presentation, you'll be motivated to start things early. And at the end, I hope that I'll be able to help somebody out there. So let's get straight to the PowerPoints. So back then in 2021, mid-2021, my portfolio was already on the way down because I started to accumulate stock in China, Hong Kong, and the property market was already correcting back then since 2020. And in 2021, I started accumulating stocks in certain property developers, and they do pretty badly. And no one would have thought how badly the market how bad the drawdown would last. Because if you remember, Alibaba was at a high of $200, $300, and it crashed all the way down to $60 over. So that's pretty dramatic for a large cap company. Along the way, I also bought and paper handlings to sell some stocks in China. Most of them are actually earnings play, means that I was buying them based on earnings, and buying stock based on earnings is actually pretty tough. In 2022, my mom also had to go through quite a few medical examinations because there was some results from blood tests indicating that she could have some problems in her body. So we went through colonography, we went through a colonoscopy and all that. And towards the end of 2022, she was actually hospitalized, sent to hospital because of diabetes, neuropathy, breakdown. Basically, the doctor said that there's a problem with the nerves, and she was vomiting, she was temporarily blind or that, and sent to hospital. Yeah. In 2022, there was also this stock of mine called TTJ that went private, but it went private at a very disappointingly low price. So my returns was actually subpar. One of my stock went up 20% and go back all the way down to zero because the dividends payout was on the low side. The management decided not to return to pre-COVID dividends level despite earnings improving. The stock market pretty much recovered towards the end of 2022, but I'm still making a net loss. much lesser than how it would be in 2021 at the middle of 2022, but towards the end, the market did recover. So this was how I was performing throughout the years in terms of time-weighted returns. I choose to compare my portfolio returns against the Straits Times, the S&P 500, and the Hong Kong Tracker Fund, because realistically I have access to all three funds, and I think it's fair to compare against them because I have holdings in all of them. In 2020, it was the first year that I started investing in some American stock. So the records that you see here, starting from 2016, was when I was seriously doing value investing. Obviously, when you start investing every time at the start, you would start to do a lot of speculating, a lot of trading and all that, and that's not good. So I woke up, decided to do something based on value, and this is the record. 2022 was extremely humbling. If you look at the drawdown, right, that's how much it went from the highest of that year to the lowest. So in 2022, you had the Hong Kong market going down 35%, while my portfolio was not spared, so it went down as much as 35% as well. In terms of volatility, if you are interested in this kind of thing, your portfolio will somehow be in sync with what the market gives you. This is the so-called external internal rate of return. So before COVID came in, before 2022, I was doing too well, and it brought me down to earth. So you want to try to ignore what's on the 2023 side, because we are still very much at the start of the year, and the market went up pretty high for Hong Kong, although it does show signs of going down. So let's start off with roughly how I invest, and something that is very, very positive in terms of returns. So you get to see what happens when you get very lucky when investing. So the first thing you always want to do is to look at the balance sheet. So let's imagine that the Titanic was for sale for $200 million. And you know that Rose, if there was really such a character, discarded the Heart of the Ocean, which is the very expensive necklace. And Titanic, if you have to buy over Titanic, let's say, was put on sale for $200 million. And the actual price for Titanic, because the Heart of the Ocean was there, will be 200 minus whatever the necklace was worth. So this was how the necklace was portrayed to look like in the movie. So let's assume that the necklace worth 100 million. The Titanic cost 200 million. So, and the yearly profit that you get from operating the Titanic ship is $10 million. So what happens is, the listed price is what the stock market will quote for the entire company. With Titanic alone is $200 million. Okay, and let's assume that Titanic with the Heart of the Ocean is also worth $200 million. Okay, the actual price you paid for Titanic, if the Heart of the Ocean was not in there, is really $200 million. But with the necklace itself, you're actually paying for 100, because you could buy over Titanic and sell off the necklace. That's the whole idea. The yearly profit for both cases is $10 million. But if you look at the price multiple, means the market cap divided by the profit is actually, you're paying for 20 versus 10 over here. So the thing is that the key lesson is that if there's valuable asset in the company, you're actually paying much less than you would think it is stated on the computer or on screeners. So the company that I'm going to talk about is a company that brought me quite a bit of profit, but largely it's luck. Elaborate why. So this company is Perfect Shape. At the point of time, it was dealing predominantly with aesthetic procedures for women in Hong Kong and China, but Hong Kong is still the main market. So Perfect Shape is now known as Perfect Medical, but I'll refer to it as Perfect Shape from time to time here. Based on the interim report in 2019, it has cash and equivalent, means it has cash, it has stock, and all of that. Cash and equivalents refers to cash, as well as maybe time deposits. So at the point of time, it has about 466 million, and it has an investment portfolio of 70.6. This investment portfolio predominantly is invested in Hong Kong stocks and not of the speculative kind. All right. So if you total up all of them, okay, sorry. So there's no debt in this company, and the deferred revenue, which is basically money that is taken from customers, but could possibly be refunded, is about $120 million. So in summary, you have cash of 466, investment portfolio 70, no debt, and this deferred revenue. And the market cap, which is the amount of shares outstanding in the stock, multiplied by the stock price of that time, will equal to $2.2 billion in Hong Kong. Okay, so what's adjusted market cap? Adjusted market cap is basically the market cap that is stated, subtracted by the cash, the investment portfolio, and add that. So if you were to minus everything, the market cap, the actual price that you're paying for Perfect Shape is only $1.5 billion. So the next thing you want to look at is the earnings. And this was the long-term earnings that Perfect Shape had. As you could see, even since 2011, it was largely profitable. The gross margin has always been pretty high. The net income, the net margin has always been in the early teens to the high 20s. All right. And the earnings in terms of earnings per share is increasing year to year. So there's something called CAGR over here. CAGR basically means compound annual growth or return. So from this to this, right, if you're talking about the returns annualized, it's actually 16.71%. So the top line is growing at 16.17%. The net income is growing at 23 or 24%. And this is what we call cash flow. So it's a bit difficult to understand if you are not investing or you have no idea what financial statements that are. But for those who know, right, this is basically what the actual cash transaction that you get year to year. So the free cash flow was actually increasing over the years. And these are the return metrics. This one, if you're not too familiar with investing, you might want to ignore this, but you have to take my word that when it's 16%, we get a company that's returning about 16% or so, it's actually a very good company. So this company was returning well over 20, and in some of the good years, about 40, 50. So what's no growth earnings? It bears some explanation. So when you are looking at a company, and let's say the company is worth, in this case, Perfect Shape, about $2+ billion in market cap, you look at the earnings and maybe it's about $200 million. So some people might want to assume that, let's say if the earnings grow over the years, right, it's actually going to be worth more. Okay, the stock market will also value the stock higher. Okay, but when we try to look at things from a more prudent angle and assume that the earnings does not grow, how much are you paying for the company? So let's say if Perfect Shape was to generate $300 million in cash or net income versus a adjusted market cap of 1.5 billion. Remember that it was quoted at 2.2 billion, but it's actually about $700 million in liquid assets. So you're actually paying for $1.5 billion. So if you take 1.5 divided by 300, that will give you a multiple about 5, which is really, really, really cheap. And take note that this company is actually growing at a pretty moderate pace. So during COVID, the price actually went down from 1.95 to 1.5, which is about a 25% drop. It's not very, very steep, but it's not little either. So Perfect Shape was one of the weird stock that I bought because I went out of I broke my rule of buying more stock as the price went up, because I believe that at the point of time when I buy more stock, I believe that there's actually value. It's still cheap in terms of what the financial statements are telling me. So I actually stopped buying at a certain point. So what's next here is the buying records of my stock. So in March 2020, I was buying stock at $1.95, and when COVID became something pretty prevalent throughout the world, in March 2020, it went down to 1.56, and I've been buying it ever since 2.33, 2.1, all the way until it was $3.14, which I think it was roughly giving me about a 25% to 30% in terms of margin of safety. So what's margin of safety? Let's say if you think that the stock is worth $4, $5, you wouldn't want to buy the stock at $4 or $5. You want to buy the stock at a much lower price. So that was what I think Perfect Shape was worth, between $4 to $5. So what happened next was that the market went crazy for the stock. So I bought it. The last time that I bought it was somewhere before this, and it actually doubled and tripled to $10. And the stock ballooned really, really quickly over the months. And the turning point came in June 2021. And as you can see, somewhere about here, that was where the stock started to drop because the earnings was actually pretty disappointing. So one thing you want to take away from this is that sometimes the stock market, the stock price movement does not reflect reality. It could just reflect the expectation of the masses. All right. So between 2021 and 2020, the net income, which is the bottom line, the company actually earned improvement about $30 million to $40 million, which is not a lot. And the revenue actually increased just a little bit. So why did I sell the stock? If you look at the market cap in 2020 March, it was $2.18 billion. But in a matter of 1 year or so, it went to $10 billion. So if we look at the cash equivalent of then and that, is 530 million here. So we probably have about 1.5 billion adjusted market cap. And back in 2021, it actually went balloon to $9.3 billion. But the earnings did not increase a lot, as you could see. So the earnings per share back then was 28.7 and 32.1 here in July. And the adjusted so-called price earnings, right? If you take whatever here to the market cap, it's about 5 times back then when I bought the stock. But in July 2021, it actually went to 9.3 billion based on the earnings of 348 million. You are paying for 27 times. So why is this actually luck? The thing is, the market went crazy for the stock, and you cannot control how the market thinks. You cannot anticipate how the market thinks. I actually think that Perfect Shape was worth $4 to $5. So the market give me an additional $5 or so, $4 or so for the stock, which I'm only responsible for that maybe 100% of the profit, but that rest of the 200% is really luck. So I was also lucky because I bought more stock because my parents passed me some money to invest. And I hang on to the stock because even though it was increasing rapidly, because I was waiting to see the earnings, I was giving the market the benefit of the doubt. So these are all my sell records. I start selling the stock at 4.7, okay? And I held on to most of it. As it went out to 7.43, I think maybe the market is getting a bit crazy. I sold more stock. And towards June, I sold some more. And at the end, when we look over the earnings report and realize that there's actually not much of a promise there, the market was really purely speculative, I just sold everything. So as you can see, the highest that I sold was 8.7. And the stock actually went up to 10. So you could never really buy at the bottom or sell at the top. All right. So I'll take a bit of time to talk about value investing. Okay. So the thing is, right, most people tend to cheer or boo the loudest when change is about to come. This was February 2021, and the stock market was doing very well for some stocks which are actually selling at a very, very high price. Back then, value investing was considered dead and everybody was writing it off. And the ARK funds was everything. Disruption was everything. We all know what happened in 2022. ARK funds become the dog and value investing is suddenly working again. The thing is, guys, value always works. You guys just have the wrong expectations. The thing is, right, we as value investors don't care whether it's dead or not. It benefits us when there are fewer people believing in value investing. We need skeptics to sell down the stock. And while you're busy running away during panics, we'll buy from you. When you're hallucinating about the returns, we will sell it to you. So what I am, I've been told that I'm actually a very linear person. My approach has been too linear. I'm too simple-minded. I'm not financially trained. I'm too stupid for CFA level 1. I tried, but I think the content is too tough for me. I earn lower than the median wage and I'm just a small IT support staff. So I have no access to all these high-end financial knowledge. I avoid popular stocks. So there were, every time somebody will ask me about Tesla and all that, to be honest, I never really pay attention to them. I just avoid the stock no matter how well the stock does, because it's just simply too popular. I don't use any kind of charting or technical analysis. I don't use margin. I don't use options. Most of my holdings do not have tradable options. So for the uninitiated, right, options usually only exist for the very big companies or liquid companies, the bigger companies in Hong Kong. My stocks are predominantly in Singapore and Hong Kong, and the stocks that I own in Hong Kong are usually very small companies, so they don't have options. I did not benefit from a single hot sector. In 2020, you have all the growth and tech companies that went up so much. In 2019, you have REITs, and now at this moment, you have artificial intelligence being the hot topic. So the stock did go up a lot for a lot of artificial intelligence company, but I don't have them. All my stocks are losers, or all of them are cheap. So this is not a stock market stock recommendation because I might just liquidate them any point of time without telling you. So I hope that nobody really follow me blindly. So just to sound outside example, if you look at the company like Yang Finance, right, it was a trash from the spin-off. I'll talk more about spin-off later on. The reason why I bought it because I think it's sold down way than it deserved. There are stocks that were simply just cheap, and there were stocks that had problems. For example, KP was a problem stock. It had a fatal accident, and the stock was, was cheap by book value. My approach has been largely influenced by this guy called Walter Strauss. He used very simple investing techniques like investing by book value, examining what's in the assets. He did not come from a privileged background, where most of his clients were poor immigrants. So very much like him, I don't come from a family of wealth. My parents are all blue collar laborers. So I was not taught how to invest. I was only taught how to save and spend as little as I could. So investing was never part of my world until maybe 7-8 years ago. There are a few very important pillars of thought from Walter Strauss. The first thing is that he only look at book value and he doesn't really pay much attention to earnings. There are a few reasons. First, that earnings change very, very often. And second, people's opinions of earnings are different from time to time. So let's say if the automobile sector is very promising and investors sometimes will pay over the moon. They'll pay 20, 30, 40, 50, 60, 100 years of earnings for the stock, 100 multiples for yearly earnings for the stock. But when times are very bad, that could drop very dramatically. The other thing about the companies that Strauss owns, they all have problems. They are depressed. There's no guarantee that any one of them have winners. But if you buy 15 or 20 of them, if you diversify in a sensible manner, you do okay. And there are three things that will happen when you buy this kind of stock. The first is when the company has problems, it can overcome its problems, and the stock market would price them back up. The second thing that will happen is because when the stock is too cheap, right, the owners or somebody in the know in the industry will know it, and they will very likely come in and buy control of the company. It's also known as going private transaction. And third, the company could start to buy their own stock, and in the end, maybe even ask for tenders. Means, let's say the stock is selling at maybe $20, and the market and the company management thinks that it's too cheap. So you might say, oh, I'm willing to buy, take in maybe $22 worth. I'm willing to buy stocks at $22 based on a certain amount of stock, based on the amount of money that I can get, to simplify the explanation. But basically that's what tender offer means. So some of the gains that you can get from buying cheap stocks, these were some of the holdings that returned me quite favorably. So as you could see, those stocks in highlighted portions, right, are all taken into private. Are all taken private. Some of them taken private by the owners themselves, some of them by third party. So now the thing about investing is you need to have an idea about what the stock market does. The stock market is generally quite efficient, but the thing is, it will only be significantly inefficient during uncertainty. What does that mean? It means that most of the time, the stock market does a pretty good job at valuing securities, valuing companies' worth. But when there are problems, that's where there are significant discounts. All right. So we do not act when that gap between value and price is insignificant. For example, let's say we believe that the stock is worth $10, and maybe there's a small problem and the market price it down to $9 or so. We don't act. All right. So there are three kinds of problems, I believe, that happens in the stock market. So there are three different levels. All right. The first is worldwide and regional problems. So for something like COVID and trade war, it affects the entire world or most part of this world. So how often does this happen? This does not happen very frequently. Does this event impact the worth of a company? It's very unlikely. So let's say if there's a trade war, there's a COVID situation, and let's say the bank stock went down 30, 40, 50%, does it really impact this company's value permanently? The answer should be likely not. So this is what I felt about impairment when it comes to worldwide and regional problems. The expected kind of returns that you will get when you invest in this kind will be average. And there's also sector-related problems which happen frequently, and company-level problems which happens very, very frequently. But the difference is that when you buy companies that have problems, there's a possibility that it will impair the value. But the returns you get when you bet on these kind of companies are the best, of one or three. All right. So I would show you some case studies later on the companies that I buy when the company itself had problems and the rest of the world didn't. So the basic strategy is to determine if the problems are temporary. If there are no known problems and the stock is cheap, usually the company is the problem. And when it's beyond your ability to guess whether it's temporarily, you should pass on the idea. You should give up. So you should use very simple ways to determine if there's a value. And when the stock goes down, the risk is actually lower. You have to be patient. You buy and wait for. And most of my holdings, I actually wait for maybe more than 3 years, some 6 years. Dividends pays you for waiting. I'm patient, but when somebody call me a long-term investor, I wouldn't say so, because sometimes the stock does surge and I do sell. So take care of the downside first. Always invest by protection instead of projection. Protection means you think that the asset, there's $10 worth of asset, okay? And and when the stock price went to 6, that's very safe for you because you know roughly there's about $10 worth of asset. Projection is thinking about how much the company will earn and now in the future. So thinking in terms of projection is actually pretty tough. I invest like 80s. I only need annual reports. I don't need any sell-side analyst recommendation, YouTube, rumors. I have zero interest in macroeconomics. macroeconomics is like wind in the desert. Firstly, even if you are economist, right, you have to understand that the stock market does not follow macroeconomics in a timely or immediate fashion. It's very difficult to invest on macroeconomics. And I find that most of the time they make good kopitiam topics, but very little actionable use. So the expectations for my kind of investing is that you will beat the market modestly year on year, and you will have significant gains over the years. My holdings usually won't go up to 300%. So the market hardly goes crazy for my stocks. They are not compounders, meaning that they are not good. They don't have good earning ability. So when you hold on to them for a long time, right, it does not mean that you will gain from them. They are just very cheap. And the expectation is that sometimes it takes a long time for the value to get realized. Sometimes the price remain very low for a long time. And sometimes they shoot up in a moment of weeks or months. It's beyond your control. There are two ways where I'll search for stocks. The first way is bad news on newspaper. They are great for telling you bad news, but they are not great for telling you good news, because the focus of journalists is to tell you the bad things. There are two ways. The second way where I screen for stocks, the second way where I look for my stocks is through screening. And there are two kinds of stock screening. The first one is reactive, means you look for cheap stuff. They are all based on a mathematical ratio based on the price. Some examples will be, maybe this is the year low for that stock. And it usually happens because the stock price drop. You will end up in that screener. You have to run this screener very, very frequently. The second way to look at things from a screening perspective is to screen for good companies. So you look at them based on returns. Be it returns on asset, return on invested capital. They are not measured against price. So it means that this company might be performing very well based on the kind of assets they have, but they might not be cheap. And usually they are not cheap because the market is not stupid. They'll price them usually quite well. So you create a list of all these kind of companies and you monitor them from time to time. The best time to buy this kind of companies is during market level panics. Okay. So I never buy things full allocation. Means, let's say if I have an idea and I think that I like it and I have maybe $20,000 to buy that stock, I will not buy all 20,000. I'll buy in small steps. The disadvantage is, of course, let's say if I just bought $5,000 of that stock and the stock price went up dramatically, I don't earn a lot because it's only $5,000. So I have to accept this and I don't buy more when the price goes up. I have to control myself. Okay. The pro is that when the stock price does go down over time, from the moment you just buy it, you could actually buy more. And it gives you more time to look at the financial reports and think about the stock. It's also possible to have too much cash sometimes, so you lose discipline. So there are a few main rules on why I sell a stock. First, when it's overvalued, clearly, I found something better, there's a mistake, or I think the management is very suspicious. And lastly is delisting. Okay, so because I don't have much time, I'll probably skip this option selling thing, which is just nothing very serious. Okay, so let's go straight to some of the successful cases that I had. This was done very early in my investing life when my portfolio is really very, very, very small. But if I could, I'll stuff my portfolio with full of stocks like this. These are very, very safe ideas. So for example, Innotek, back then in 2017-18, it has $30 million in cash, 15 million in investments, 16.9 million in properties. All right. And take note that it was earning about $1.26 million in rental, also based on the investment property. So the cap rate is 7.4, means it's earning about 7.4% in rental. So the value ascribed to this investment property is likely conservative. So yes, later to know that, and the total of all these assets was worth $62 million or so. The stock market priced it at $60 million. So you must understand that these are just assets and it does not include the worth of the main business itself. which was precision machining. So most of my ideas is we will start off by looking at the balance sheet. This was cross-harbor. So I was looking through all of his assets and giving it suitable discount. Okay. So with cheap companies, right, usually the business is not doing very well, but you have protection because there are assets. The thing is, the stock market is not dumb. It's not possible for a company to do so well and be priced so little. Okay. So this was the red dots over here signifies the buying points that I bought, the points where I bought the stock. So as you can see, when I bought the stock, it was about 30 cents and it went right up to 50 cents, but I didn't sell and it went right back down again. So there are times where you really have to endure. So back then when it went back down, I actually bought some more here because I bought based on what I think the value is. I think it was more than 50, but the stock market does not agree with you. So this was the transaction records. I bought at 33.5, 31.5. It went down to 29 and I buy some more. And that was the last time I bought it. And in the end, the stock did recover to over 50 cents. So I sold. There's a happy ending, but there's also something that was not, there's a lot of learning things that you can get from buying and selling stocks that are cheap. So what happened? The business became better. So I exit at about 70% gains. This kind of company is my favorite kind of company because it's very safe. When the stock market price them down 20%, there's very little mental stress to buy more stock. All right. So the goal is to own a diversified basket. If you spend everything you had on this stock, means your portfolio only have one such company, is very stressful. So you need to diversify. And it's very easy to look at the financial statements and think about whether there's a deterioration in terms of the book value. Okay, now I might have bought this stock when it was about 30 cents. And it's about here. Okay, and I might have sold it when it was about here. And I'll feel good when it went down, right? But really, look at what happened after that. It went to $1 and it went back down again. So it show you the perils of buying stocks and selling stocks like this. You will never be able to catch the top, and you probably will never be able to catch the bottom. And these stocks are not suitable for long-term holding. TTJ is one of the very disappointing case that I bought, and with failures, they always give you the most lessons. First off, it's a steel fabricating company. It went down a lot in 2017 because it lost the dormitory operation contract, which represents about 40% of their revenue. And most of the time, the owner actually owns 85% of the entire company. For the uninformed, right, when an owner owns 90% of the entire company, they can force the rest of the investors to exit the stock. So it was very close to going private. Okay, so at that point of time, most people would think that the stock is likely to go private. Okay, as you can see in 2017, because of the earning deterioration, right, dividends actually dropped. And during COVID, that was what you get per year. So dividend yield is based on the price of that year. So if you compare this against so-called risk-free rates, T-bills, this wasn't great back then, but you must remember in 2020, it was still the era of low interest rates. And these are the dividend payout, means based on profit, how much are they giving up in dividends? All right, so it was quite depressed over the years. So I started buying this stock when it was about 36 cents, and it went all the way down to as low as 11 cents. As you could see, I started buying at about 33, and it went down all the way. The thing is, with this kind of cheap companies, right, when it went down a lot, when the stock market panics, it does give you the opportunity to buy them, because usually during normal times, liquidity means there are very few people buying and selling stock. But during market panics, you had the chance to accumulate. The thing is, the transaction that are highlighted in red here, I was actually very lucky to have bought stock back then, because the stock actually went private at a very low price. If it wasn't for these 4 transactions, I would have lost money. So another thing I want to comment is that when you buy stock that are cheap during market drawdown, means during market panics, it's actually a very stupid idea. Because during market panics, you should be buying the good companies. You should be having a list of those good companies ready, and you act when the market panics. You don't wait until the market panics and then you look for this company. Usually it'll be too late. All right. So one thing is that when the market when the company owner decided to take the company private, I was pretty much against the idea. But there was a lot of talk about how cheaply the company was being taken private versus the net asset value. For those uninitiated, right, net asset value is basically a very simple way of calculating stock. You just take the amount of assets that you have, subtract by your liabilities, and divide it by number of shares. All right. But really, right, the quality of what the asset, the quality of the assets that the company has is actually more important. So what I was trying to do here is to show you how to evaluate companies that are cheap. So this is what happens. You look at the liquid assets first. Okay, these are the cash and equivalent. It has 29 millions of cash. So there's really no need to discount anything. Cash is cash. Trade and receivables are money that are owed to the customers. Owed to the customers. The customer owes the company this amount. So it's reasonable to believe that maybe there will be bad customers that doesn't pay up. So we do a bit of discounting here. Contract assets is how much the projects are likely to be worth. So we will discount them even further, a 20% discount. We also look at the properties that you own. So these are the properties that it costs them to buy. And this particular JB factory that you had, you already disposed, means you already sold it. So there's no discount needed. And when you buy properties, usually is going to go up over time. So there's no discounting needed. So if we just take the assets that we were talking about earlier on and add them out all together, subtract by liabilities, is worth 24.8 cents per share. The company owner wanted to take the company private at 23. So the last thing that we didn't do is to evaluate the actual steel business that he owns. So if we take into account the worst year earnings over the years, he earns 28 million. And during the best year, he earned 56. So if you just take a 7 times multiple, right, it's actually worth between 33 cents to 14 cents. All right. And the owner wanted to take it private at 23. So there's a few things that you need to take note. You can take from my experience here is that it requires disciplined buying, even though when the price falls pretty badly. You don't get a lot of information with this kind of stock. So sometimes you'll be thinking, is there some kind of insider leakage and all that? There's not a lot of people talking about these stocks. So you have to make your own decisions. There's also a lack of liquidity. It means if you own a lot of such companies, right, during normal times, you might find it very difficult to sell the stock. So you need to manage your portfolio well. Don't have too much of that. Time is an enemy, meaning you could hold these kind of cheap companies for a long time and the market and the price will not go up. You'll stay roughly there until one fine day something happens. So when that happens, it could take a long time, it could take a short time. But if you own a basket of such stocks, usually you'll do okay. This is just an example of how tough it can be to buy stocks that are cheap. You can buy stocks starting at $1.77. And when you go to 0.65, you still be buying them. So TTJ was a great lesson because when I started buying it, it wasn't really super cheap. I failed to see that the owner was not actually very friendly to small shareholders. And I actually got warnings from friends about this. So I kind of ignore their well-wished warnings, well-intended warnings. If not for the purchase that was bought earlier on, I would still lose money. And in the end, it was forced to delist at a very low price. I'll skip this because there's not enough time. So, Bunty, we got 45 minutes already. So do you want me to carry on?
You decide.
Okay, I think I should carry on with at least this one, because this one actually is the more important slide. So this company called Xinghua Port is actually my favorite stock over the years, because it gives me the most valuable lessons. It does not give me the most amount of returns, but it does educate me. So originally, Xinghua Port was a spin-off play. It was under this company called Pan United. And one day, Pan United decided to let this subsidiary go public on itself, on its own legs. So it decided to give one share of this company to every existing Pan United shareholders. So this is what we call a spin-off. The main business is actually port business, handling cargo, and spin-off are actually what we call special situations. Okay, parent company decided that the existing shareholder receive stock. So a listed company like Pan United let this company go independently and distribute on a share of 1-to-1 basis. So there are a few reasons why spin-off happens. First thing is to highlight the business the value of the remaining business. So perhaps Pan United could be worth maybe $200 million. And let's say Xinghua Port is worth is valued at $160 million. So the remaining business is actually 40 million. And if it was actually earning more than that, it's cheap. So sometimes spin-off does tell you certain things. Sometimes spin-off could be used to relieve the parent of rubbish companies. So maybe this particular subsidiary is losing a lot of money, and the parent could use this spin-off to take it out of the company to make it look more attractive. All right. Sometimes it could be politics. They could be forced by regulation to relieve the subsidiary from its books. The typical outcome from spin-off. So it won't usually be as dramatic as this. But when the parent company is a very big company, 17 billion in this example, and when you have a big company like this, you usually have a lot of institutional investors, means big buyers, insurance companies, sovereign funds, and all that. So when they spin off a company as small as this, which is actually only worth 1.63 billion, the existing shareholders would just sell the stock without thinking. So if you look at Beta, it was listed at $45 million at the first day, on the first few days, and it dropped dramatically in 37% in 2 days. So likewise, right, Xinghua Port is also exhibiting this kind of sell-off pressure. It was listed at about 1.3 and it went to between $1 and about $1.10. So it's still a pretty reasonable discount. What I didn't expect was that on the 31st of March, there was a fatal accident. So it resulted in the suspension of operations for both ports that it owns. And it went down 37% in 3 months. What happened was I sold half my position during the uncertainty, also known as paper hands. The reason is this: I didn't know how long the suspension would last, and I do not know the repercussions. But what happened was when I sold the stock, the owner actually bought my shares because I was looking at insider transactions. And time passes, and I attended the AGM, and I actually realized that the management are really good people. They were working hard to resolve the problem, and as time passes, I bought more stock. So this was during the trade war period where Trump was using all kinds of tariff to apply pressure to China. But the owners assure us that the cargo that they handle, they are not subjected to tariffs. So what I did was I constantly add. So this was how much it went down, and it lasted for months. So sometimes when you buy stocks like this, the kind of the amount of time that you have to endure could be pretty long. So this is one thing about value investing. But during 2018, I was looking back at the kind of earnings that you got. So how do you get this data? Is you look through the parent's annual report. So Pan United was the parent, And within the annual reports, there's actually a section that talks about its various segments. So it does list down the revenue that it got and the profits that it get. And if you look over the years, it's actually doing pretty well, the ports business. All right. Ignore this price to earnings thing if you do not understand much about investing, but you could see that it's actually doing pretty well. In 2017, it was also it was under pressure because of the accident, so it earned pretty much lesser. All right. So what happened in 2018? It earns 51 million renminbi. And in 2019, it actually start to recover, 83 million. And eventually in the year 2020, during the first half alone, it earns 55.6. So you could see clearly that earnings recovered. There was a happy ending to this story because eventually the third party I believe it was China SOE, state-owned enterprise, decided to take this company private, bought over the company, and it went from 0.8 right up to 2.56. But obviously, I didn't enjoy the full 2.56, the 2.59, sorry. So what happened was, this was the point where I sold during the operations. I sold half because I was scared, like most people. The thing is that sometimes, right, the stock market could just have this intraday surge. There was such case. So in 2019, in April, right, it went up 60% in one day. I have no idea what happened, but I sold some. And during COVID, I bought more as it went from 0.96 to 0.73. And for some reason, the stock started to surge during mid-2020. And eventually, I sold all my stock at 1.98, which is very close to $2. And just a few weeks later, the news came out that they're taking over the company. So I bought some stock as an arbitrage play. So there was only a little bit of meat left between the final offer price and the price where it was still trading just before that. All right. So there are a few things that I learned from this experience is that optimism is immaterial when the company is going from good to great. When a company was doing very well and you say that you're optimistic, actually doesn't help you much. True optimism comes when you believe that you will stand out after a fall. When the company is in bad times and you buy it, that's true optimism. The incident, while being very tragic, does not impact earnings. Earnings recover in the end, and I had the time to look at and assess management in annual general meetings, and I think that the management characters are sound. Xinghua Port changed my idea about investing. I believe that when you buy stock, you should buy it when there are problems. And market efficiency is always impact during these kind of uncertainties. When you have undervaluation and you had a known problem, and when the company does recover from the problem, you will get attractive returns. The last thing I want to talk about spin-off is not every spin-off situation pays off. For example, Yangzijiang Shipbuilding Holdings, right? The thing about Yangzijiang Shipbuilding, prior to its spin-off, is that Yangzijiang always had this item in their balance sheet known as investment portfolio. But over the years, nobody had any idea what that investment portfolio consists of. So one fine day, they decided to list out that investment part of the business by itself and call it Yangzijiang Finance. So on the day where Yangzijiang Finance was trading, right, to now, it actually lost 41%. Whereas the parent, Yangzijiang Shipbuilding, went up 68%. So this is a classic case of parent disposing the so-called rubbish. And not surprisingly, I own the rubbish because I think that, personal opinion, I think that is being sold off way more than it should be. This one is actually very brief. So there's only, I think, 4 more slides. So Emperor Entertainment Hotel is actually a casino kind of company, all right? It was trading at $1.7 before COVID. And when COVID came in, you had all kinds of lockdown. So when it went from when COVID came in, it went down from 1.7 to 1.1. Okay, and I start buying stock in September 2020. It has 3.3 billion in cash and equivalents, and the total amount of liabilities is 550 million. So there's a net of about $2.7 billion in cash and equivalents alone without anything else. The market capitalization then was 1.4. So we are talking about maybe close to 100% discrepancy between value and price. Earnings was affected by COVID, but during September, that was where I think the vaccines were being discovered. So it's quite sensible to think that COVID would eventually be a problem of the past. So I thought that it was temporarily. Now, the thing is, you will be buying stocks as it goes now. So that was what I did. But eventually, I sold at a very small difference because on the 16th of March, right, the parent decided to offload, the parent company that owns this casino operation decided to offload $2 billion worth of property to this subsidiary in exchange for cash. So all that so-called $2.7 billion of excess cash over liabilities are all lost in exchange for property which might or might not be sold at a reasonable price. So the value proposition just disappeared overnight. And when you look at things like that, you have to sell without any kind of hesitation because this is a value destructive move. As I wrote, it was 0.62. So I sold at 1.1. It did dangle around in 2021 to 1.15. And that's the amount of loss that you could have if you just stay on. It's possible for a parent to so-called sell and sacrifice a subsidiary. And in Asia, this problem is actually pretty bad because most of the time, the owners own a lot of shares. There's no way for a third party, the activists, to come into the picture and wrestle the control of the company and force them to do the right thing. With that, I'm done with my presentation, so we can proceed to Q&A.
Take a sip of water first.
Yeah.
1 hour, 1 hour of presentation. Thanks a lot for the sharing. I think that's a very good presentations and a lot of learning points there. I think we will go through the Slido question first. No, Slido, sorry. I will go through the questions in the Zoom first. There are like 2 or 3 questions there. And then after that, we follow up with the Slido questions. I think Slido there's a lot more questions to go on. So I'll proceed to ask the first question from PB. Hi, Boonsong, how do you look for ideas like perfect medicals? Someone told you read somewhere, or one stock, check the numbers. Okay.
Perfect Medical was purely from Stock Cafe screening. So there's this website called Stock Cafe. Periodically, I will look for companies through screening. Screening means using a computer service to look for companies based on certain criteria. Perfect Shape was a company that was returning very good numbers. So it's a so-called a good company. Yeah. So I found it and I do very basic valuation and I found it to be ridiculously cheap. So it was luck that I found that stock.
So it started out from the screening, and then you haven't really heard about other people write anything. Okay.
Never. I'm just an ugly old man in Singapore. How would I know of a beauty company in Hong Kong?
But after that, how? Like after you do the screening, you saw the numbers, you check the numbers, it fits, then you started out to check if anyone talk about this stock, or you can just proceed without hearing anyone talk about the stock.
Nobody actually was talking about that stock. Okay. I checked investing notes.
All right.
Nobody.
All right. Okay, then second question is also from PB. If you start earlier, would you be stuck with a lot of China stocks listed in SGX? How you avoid stepping into them if you had stated earlier?
I have a help. There are seniors out there that told me to look out for them. So I was very, very lucky. The thing is, right, with most things in life, how you fare, right, is the kind of social circle that you have. So I had free advice. I have free advice from people who are smarter than me. I'm very fortunate. Yeah, next question.
Okay. Next one from A. What would you buy and sell price for DBSB? Thanks.
You never know when you can sell DBS at, but you need to have courage to buy when DBS goes down a lot. Sorry, I can't help with this. This is stock recommendation. Not a good question to ask. The thing is, when I tell people about my perfect shape idea, I really think that it's worth only $4 to $5. But and you could see that I didn't buy more when it's beyond $3. But I got a lot of abuse when perfect ship went to $8, $9. Nobody knows. DVS, I never thought that it went to 36. I seen it went to 13. I seen it went to 15. But to say that you should only sell when it hit 36, nobody can do that. It's easy to tell you when to buy, but nobody can tell you how much you can profit.
Yeah. Okay. Next question is from PB again. If the business don't require the cash, hold too much cash in excess of what their operations needs, is it not an efficient use of capital and consider lousy management? The management keep the cash and don't disperse out to shareholders.
True. But you need to understand that there might come one day where the owner will just go private. And then you lan. No choice. That's how stock market is. The thing is, right, if the owner don't need you to take risk with them, they would have never listed the stock. It's a very unfair world. Okay. There are two ways where company owners get money, get capital, and they'll prefer to take capital from the cheaper alternative. All right. So they either borrow money or they raise stock. They sell stock. Okay. So they are not being kind to you. They are capitalists. So when the stock is cheap, okay, they will make sure they take over the company. Yeah, that's how unfair this world is, but that's how it is.
Let me add on to these questions. So when I've noticed that you focus a lot more on the management, like whether you want to trust them or not based on what you see when attending the AGM. So there are a few things when we look at management. For example, you are looking at their strategy, their executions, and so on. This is one part. The other part is like how they manage their capitals. Say, for example, do they do share buyback? Do they like issue dividends? These kind of things. Like how much weight you put into management, like integrity and their capital allocations when you're deciding how they are good or bad?
When the stock market went down a lot, I would expect them to use their own money to buy the stock. Using the company's money to buy a stock doesn't mean much to me. And most of the time, it could tell me that the company is getting very desperate. But when I quote management character being sound or being good, right, it's through personal observation during AGM. I could see a few things. First, I could see whether the independent directors are actually independent. I could tell whether the directors, the executive directors like each other, whether they bother to stay after the AGM to talk to shareholders, or they are in a rush to go to the next party in their Ferrari or Bugatti. Yeah, I saw that kind of thing. Yeah. So it sounds very rudimentary, but that's how it is.
Okay. The other one from Teng Wong. How do you make judgment when to sell a stock? And what is the method to judge management? I think it's similar to the previous questions, but you can see
the
whether
sell a stock part really, there's only four. First is, of course, you have no choice, delisting. Second, when you find something better. Third, when you need the money. Or fourth, when it's clearly overvalued. It's really only these four ideas. It's not because the stock price dropped a lot. Yeah, it's very painful. When the stock price dropped a lot, we have a lot of 50% drops, 60, 70% drops. You have to endure. But it's not a good, I mean, it sounds very nice to say these things, but it's not a good idea to sell because the stock price dropped. In fact, the odds are better now to buy, but you're selling. And most of the time, you're selling to people who are very altruistic, very opportunistic. Yeah. But if you need the money, sell. If you can't sleep, sell. I mean, the best advice I actually get from somebody when it comes to selling is, first, you can choose to sell half. Then you won't feel so bad when the stock price goes up. If the stock price goes up, you still got half. If the stock price goes down a lot, you at least you sold half, you see? Yeah. And the second advice I actually got from people when it comes to selling is, imagine if your spouse, you wake up one day and your spouse or your best friend sold the stock for you. Will you be in a hurry to buy back the stock? And if you are not in a hurry to buy back the stock, then it's fine to sell. That's how you deal with it, mentally.
Yeah, these are These are good emotional management.
Yeah, I think that's all of the
Yep. That's all
questions.
from Zoom. Let's move on to Slido. I think Slido there's a lot more interesting questions. We'll just go through according to the sequence that we arranged yesterday. So we won't open up the Slido here. We already have the questions on hand. So the first one, what do you do full time? How do you find time to screen or do deep dives into deep value, especially when it is not well covered?
I'm just a small kacang puteh staff in NTU. So I have a very fixed working hours. I also don't have kids, single. So I could read stuff. But I'm not that good. I can tell you that. I'm not that good in my search stock picking process. There are a lot of people smarter than me. For example, there was once I was looking at Hourglass. It's a watch company. Very, very cheap. Very, very consistent, profitable operations over the years. And I talked to people about it, and one of them is called Xiao Boy, right? We all know him. And he told me, why didn't I look at Cortina instead? And Cortina turns out to be better. So my stock picking process is not as good as others. The thing is, when you have no time, you can leverage, all right? You can make use of other people's effort. So you could look at forums, you could look at Value Buddies, Investing Note, Xieqiu. Xieqiu is a Hong Kong site, but I can't read Chinese. So the thing is, right, you can also read brokerage reports. You don't necessarily need to read their so-called target price, their forecast earnings, but you could read what they describe the company does. So it's a way to reduce the amount of time you need to research stocks. Yeah, next question.
Okay, the next question's a bit sensitive, personal one. So, but I'll see what you want to comment on. So the question is, how much do you earn?
Yeah. I think it's an important question because really, when you are interested in investing, right, you tend to look at a lot of prominent bloggers, investment YouTube channels, and these people actually earn a lot of money, or they come from a family of wealth. I'm neither. So I actually earn less than 5K before CPF deduction. And the thing is, I worked for 20 years. Yeah, so it's really very much below medium by many measures. Yeah, this question.
Just for those who are asking these questions, right, you can ask Boonsong and he shared, right? But if you ask me, I'll pass. Okay, next one. Is Bunti and Boonsong brothers?
No, we don't have the same surname. We are not even born in the same country. Yeah, but Bunti is a smarter guy, and she's better at connecting with people.
No, I disagree. I think we are brothers.
I'm not that word.
Brothers, there's many meanings, right? It's not by blood, but definitely we are brothers. That's why we are all in the same channel here. Okay, you want to add anything? If not,
no.
Okay. Next one. What does it mean for you to be happy in life? Wow, philosophical questions.
Yeah. Every day, actually, I just wish, because death comes to all. So eventually, our parents will pass. So I just wish that my parents will leave this world in a very painless manner. It's actually, for most of the things in my life, right, the things that I wish for, nobody can give me. And asking for this particular wish that my parents will leave this world in a painless manner is actually a very big ask. But what does it mean to be happy? I think in most parts, right, you actually gone through some kind of suffering for something you want. All right. So if you really wanted something and you suffer for it and eventually you got it, you probably will be happy. But there will be a point of time where you suffer too much, and it becomes and eventually if you get what you want, it becomes relief. I think that's my definition. If somehow one day, right, there's a cure for diabetes, I'll be very happy. I'll be very relieved because my mom has suffered for so long. Diabetes is something that you have to fight every single day. And my mom's age, she's supposed to consume food that is tasty. Sorry, And my mom's age, she's supposed to be enjoying life, but she still had to watch what she eats, and occasionally she had very bad medical episodes. So the only person that have so-called, the only entity in this world that has so-called happiness, pure happiness, is a dog. So unfortunately, dog can't talk to us. The dog don't have to know you to be happy. It doesn't have to have feelings associated with you. For example, if you feed a cat a lot of times, the cat grow to associate you with food, and the cat will be very happy to see you. But the dog never has such so-called needs. So I wish I could know what goes on in the dog's mind. Yeah. If I'm ever be so lucky to end up in heaven and I could talk to a dog, I'll ask the dog, what is happiness? Yeah, this
Wow.
question.
Very, very deep. Okay. Next one. Other than Boonti and Boonsong, who is good in Telegram to learn from? Because quite few like to give comments, but seems like noise. Free advice is costly.
If I'm a trader, right, I can tell you who are the good traders, but because I do value, because I invest in a value-oriented proposition, I can only tell you that people like Keith, they know what I'm doing and more. They are actually very knowledgeable. Xiaoboy is another. Hayden is another guy who invests in this, who doesn't really invest exactly in the same way as I do, but all of us invest in a value-oriented method. The thing is, they might not give a lot of advice, but because we tend to be very responsible in what we say, we don't want you to suffer like us sometimes. The kind of drawdown that you can get buying the kind of stocks that we have, it takes a lot to endure, and you sometimes cannot tahan. I also cannot tahan during 2022. Wow, Alibaba went down so much. And the worst part is I didn't think Alibaba was that cheap, but endure. And it's a character thing, you see. So sometimes people don't give you advice. It's not because they are selfish. Yeah, they have a well-being at heart. But outside Telegram, right, that sometimes I'll look at the fifth person because they give very factual kind of thing, and their videos are not overly long. So I like their kind of videos. Yeah. The thing about investing is you need to separate between opinion and facts. When somebody says something, you need to discern whether it's an opinion, and it has to be logical. It cannot be assumptions. For example, somebody will say, maybe I believe the crisis will come very soon because this economic factor show this and this and this. Reasonable, but we all know that the market don't follow the economy so closely and timely. Yeah, but reasonable. But there are sometimes people giving you opinions. Try to ignore. Be sensible. Yeah, this question.
Yeah, I think even for facts, right, you also need to fact check it to make sure that the facts is correct. Okay, the next one. What is financial freedom meant to you? Do you have a number for your retirement?
I don't have a number because my net worth is so far. It's like you're running a marathon, right? It just started. And then you are so far away from the finishing line. I don't dare to think about that number. But I know what financial freedom means to me. Recently, my mom had to quit her job. She's 70 years old. She possibly could be the most hardworking person you ever seen, but because of her health, she has been panting a lot these days due to her diabetes. And the manager actually asked her to take on more duties and work longer hours because probably her work ethic impressed her. Okay. But my mom couldn't take it, and she told me to inform the manager pretty late at night. And the manager was quite angry. And she insists that my mom return the next day to work, which is to me reasonable because she couldn't find a replacement that day. But what I couldn't take it was that the manager said, if I couldn't find a person the day after, you also must come, else I will dock your pay. I don't like it. I mean, I don't think my mother need to go through all this, and I don't think anybody need to go through this. In addition, I do think that when I look at certain colleagues at my workplace, when they're getting of old age, right, they're sometimes treated pretty unfairly, and I think I wish they do not have to go through this. I wish that they are financially secure after retirement. So that's what financial freedom means to me. Having the dignity during retirement. Next question.
If you are at 7M40, would you retire or continue working? If you think high chance 10 million 43 or 15 million 48. A lot of numbers here.
You asked the wrong person, basically, because I live very frugally. Yeah. But if you can if you are 7 million at 40 years old, you don't need my advice because you're rich. You're probably smarter than me. At 43 years old, if you think that you can get 10 million, right? You are getting like 50% in 3 years. And at 48, if you can get 50 million, you double in 8 years. If you think you can do it, you are very smart. 7 million is already a dream away from a dream. A dream within a dream.
Yeah.
Yeah. 1 million is.
I think let me rephrase the question a little bit. Don't focus too much on the number, but let's talk about like people who already have enough to secure their financial. But do you continue still working, or do you like, okay, say because I have the money, I don't need the money anymore. Should I just stop working and spend my time on other stuff? Or not? Rephrase it slightly for you.
Let's say if you know you're going to die in 3 months, would you still want to work? If your answer is yes, go to work. Yeah.
I think maybe the answer is no, because you say, okay, if I only have 3 months left, I would want to do other stuff. But that other stuff doesn't mean that you want to do those stuff for, like 10 years, 20 years, So, yeah.
I have no comment. This is too tough a question.
Okay. All right, then move on to the next one. Do you expect the fundamental rules to change for the next 5 years, because tech could be the good old shining thing, and value investing could be back instead? Oh, sorry. This one is 3-part questions. Let me find.
It's fine. Let's answer this one by one, because
I think we go
questions.
through the sequence better now. Okay.
Uh-huh.
Okay. Let me read the first one. I'm interested in how you do valuations for the company and how you review the company on what kind of frequency or rules for the last 5 years.
I like companies that are cheap based on very rudimentary and rough discounting of book values. I on the earnings front, I also like them to be cheap based on long-term average earnings. So I don't project. I look at the history, and I don't think too much about growth. You always look at the balance sheet first. And with regards to earnings release, right, I always read every quarter release, and I take a long hard look, if I could, at the annual reports. This question.
It's a continuation from the same person. Your approach and rules change before, after COVID, and before and after the inflation and interest hike.
Inflation and interest hike are macroeconomics. I don't care about macroeconomics. If we have problems affecting the entire company, right, like COVID, right, buy the good companies first. You don't get much opportunities to buy these kind of good companies. The thing is, if you're thinking about changing your approach and rules because of situations, right, you could possibly be changing your approach at the wrong time. You could possibly change your strategy at the wrong time. I think the people who had consistent returns are people who don't change their strategy. So I always be buying cheap stuff.
Okay.
I let the market bring the opportunity to you. Don't try to think about what the market will do.
Then this is the third part of the question. I repeat again. Do you expect the fundamental rules to change for the next 5 years, because tech could be the good old shining thing, and value investing could be back instead?
Okay, sorry, give me a moment. The thing is that at any point of time, there will be a sector that is very well loved. For example, now artificial intelligence, right? Everybody's going crazy for ChatGPT. And I was looking at certain stocks just now, and year to date, they're actually returning 100, 200% because they deal with AI. The thing is, value investing will always work if you stay consistent. Tech could be very cheap one day. It might seem cheap to you last year if you use certain metrics. But the thing is, the stock market, right, always price company with growth very highly. And when the growth stops, right, when the company stops to grow, you'll get punished very badly. Tech companies by itself, they are asset-light. They require very little capex, and their returns on equity, returns on invested capitals are usually very, very high. So they are good companies. Any kind of company with that kind of returns will do very well over long term. So if a company returns 16% every year, right, you would love to be the so-called private owner of a company that is. Because when a company returns you 16% every year, in 4 years' time, you get double the money. All right. But when you do get a company that has 16% return, but the revenue does not grow, the earnings does not grow, you will not get this kind of, the stock market will not love this kind of company. It's just a very strange way the stock market works. And that's why sometimes companies get privatized, even though they are cheap or they have no growth. So value investing will always work because it's simple but not easy. Just like diet. We all know how to diet, right? Just eat less, eat the right kind of food or the wrong kind of food if you are into keto. Just eat the right kind of food, do the right things. We all know how it works, but we don't do it because it's difficult. It's simple but difficult, just like value investing. You can see the price every day. Oh, this stock is trading at this price, but you need to do the work, and you need to, in order for you to think that this stock is worth this value, okay, and it takes a lot of courage to buy stock when it goes down. Yeah, the thing about value investing is people have very different ideas about risk. So what is risk to me is discrepancy between price and value. What is risk to a trader is suddenly the price dropped a lot and you didn't put the stop loss at this time, this price, or you're enduring a lot of paper loss. That's risk to them. That's what they call the downside. So the thing is that kind of the things that TA guys does is just too difficult for me. And people get very disappointed when they do value investing because they have the wrong kind of expectations in terms of returns. They think that the thing is, when Buffett was a small guy and he could buy anything he wants, no restriction in terms of company size. Unlike now, when he's now heading Berkshire, he had to buy big companies. When he was a small guy and he could buy anything he wants, he make 20+% before fees. So if a guy as smart as him can only make 20% annualized over 10 years, it's not reasonable for us to expect a value investor to make Tesla-like returns, 10 times in a year, 100% in year to date. Yeah, year to date it returns 100, right? Yeah. So it's not something that we can do. So you need market madness for that to happen, and I'm very realistic with the kind of returns I get. I'm very happy with what I get. Yeah.
What about situation like, those who look at the value, they look at the PE and they end up buying Intel, and then the earnings from lower earnings become like negative earnings. So what will you describe this kind of situation?
That's why you should not buy on earnings.
Okay.
Intel is a classic case of why I never buy things on earnings. Yeah, it's the thing is about Intel is I think the CEO is a great guy, but it's difficult. They wanted to retain dividends. This is what my friend told me because he went to read a bit about Intel. And he said that the dividends will be maintained, but I think it's pretty tough. Pretty tough. They tried to spin off Mobile-i, and it wasn't at the valuation that they were seeking for. That tells you something. Yeah, maybe they should have spin off Mobile-i during these times. When artificial intelligence is all, they will get a higher price. But that also tells you how hard it is to sell stocks. Yeah.
Okay. Next one. Don't invest because 2023 might have recession, but risk missing the REIT, or all in invest but risk losses if hard recession, which is worse?
So let's assume the market goes up 30% at the end of this year. And let's assume that you have decided to put money in the stock market. And then you'll be thinking 30% is great. It's well above market averages. Most people think of market averages at 10%. Okay, 10% return annualized. And 30% is very good. And there are so many problems in this world at the moment. The Ukraine war is still going on. There's this so-called recession that you're thinking of. And let's say you already make 30% at the end of this year. So maybe let's sell. Let's wait and see. And wait and wait for some clarity. People always like to use this word clarity. I don't understand what that means. And then the market goes up 16% the next year. Then you undo it. You'll be looking, wow, this year 30%, then I sell already. And then it went up another 60%. 30% is much more than 60%. 60% looks like it's going down, it's slowing down. The momentum is losing already. So let's wait at the sideline some more. And then the next year it went up 31%. It happened in 2019 to 21. Okay, the market is a forward-looking animal. Don't try to read the market. You what you do is, let's say if let's say there's somebody who can predict market movement and they tell you that the market will go up this year. So what are you going to do? Are you going to buy the index? You very likely will look at companies. Okay, and you still have to look at the individual companies, no matter what year is it. So you need to understand that instead of trying to read market sentiments, right, you should look at opportunities in individual companies. And if you don't have opportunities, you stay in cash. I never act based on how I think the market will do. But when I look at my capital outflows and inflows over the years, in 2017 and 21, where the market was pretty hot, right, was going up pretty much, I was a net seller. So it's just coincidental. And on other years, I was a net buyer. I think over time, it's good to buy stocks and endure the bad times, because the skies always looks better after a rain. Yeah, this question.
So your answer is just buy, and then if there's a recession, just endure lah. That's your questions lah. The worst
Yeah.
is you get out of the market and then you look at 30%, 15%, another 30% gain, and that's a lot harder for you.
The thing is, macroeconomics don't work.
I think it's not macroeconomics in this question. It's more like you buy and then it drop, or you don't buy, it go up. Which one is worse? I think it's more psychological or emotional type of question.
You remember the article, even God cannot beat DCA, right? So I don't know if we have time. So I can summarize what happened in that article. Do we have time?
Yeah, go ahead.
Okay, so basically, right, the article talks about how if somebody has godlike abilities and they can buy during dips, and otherwise they will just remain in cash. So they will only buy when there was a bottom, right? And this so-called author did a study based on rolling 40 years average. So rolling 40 years, comparing what a person with godlike abilities to buy during the dip versus somebody who just simply DCA. And 70% of the time, the DCA guy wins. The reason being, to spare you the agony of reading the whole article, is because there are times where the guy with the godlike ability actually wins. But it's because they buy the dip actually happened very early during those 40 years period. So they managed to buy and let the compounding over the years happen. All right. But most of the time you can't do it, you see. So why are you giving up all the years of compounding? Yeah. I think if you only have a handful of years, like for example, maybe you are 58, 63 years old, and or even if you have a need for a certain amount of money to be spent, maybe you only have a handful of years to stay in the market. Don't go into the market. Yeah. That's what I think of the question.
Yeah, still come back to the age, like how long time do you have?
Yeah, like my mom, I will never buy anything except T-bills. Not because I think T-bills are good, but I think she's pretty old, 70 years old. Yeah.
Okay. Okay, next one. Was there a time where you put aside value investing and bought an overvalued stocks? If so, what is it? If not, are you open to it?
Yeah, I bought this stock called Fu Shou Yuan. Fu Shou Yuan is a stock listed in Hong Kong that deals with the afterlife. So the ROE was teen-like, means it's about 16 to 12. Okay, so it's not a super performer. The thing is, it was not priced very cheap. So I've been looking at its long-term history of earnings. It's probably earning about 4.5% cash yield. So what I mean is this, it means that the market is charging you maybe $100 for it, and you're getting $4.5 in free cash flow. That's what I mean by average cash yield. All right. But I think over time it will do well. Okay. And that is one stock that I wasn't overly strict. And in that, I think it's not cheap. Okay, it might not necessarily be overvalued, but it's not cheap. And when I bought Alibaba, it was not cheap also. I think it wasn't cheap because when I look at it from the sum of the parts, right, I think too much value, too much uncertainty, right, comes from the valuation of Ant Group and Ali Cloud. So you never know how much Ali Cloud is going to be worth in the years to come. And you never know whether Ant Financials, what they call Ant Group, whether they will go IPO and what kind of price they will go for. So I think these are so-called my mistakes. Yeah. From buying
Not to
so-called
say
overvalue.
not to say mistake, it's more like it veer off slightly from the stock that you normally will buy. Or you can call it like the growth at a reasonable price, right? So
No,
put
no,
a
no,
different name. So
no,
it still
no.
belong to value investing now. It's just different subgroup.
Mistakes are mistakes. I call it as it is. Yeah,
Okay.
I'm not proud of them.
Okay.
Yeah.
Next one. What are your thoughts and opinions on investing in the Singapore stock market?
I know people think Singapore stock market is boring. The reason is very simple. There are too many smart people. There are too many institutional investors. They are smart, and the price for this kind of big companies, this kind of well-known big companies where institutional investors are people who have a lot of money to invest, and they likely can only invest in these kind of big companies. So these big companies, due to the high amount of institutional investors, they are likely to be fairly priced or overpriced. So because they are not interested in small cap stocks in Singapore, and because most of the time in Asia, these kind of small cap stocks are usually very largely under family control. So these small cap stocks are actually very, very cheap. So it's a bit of a paradox. The real advantage for investing in the Singapore stock market is, besides the lack of currency risk, is that you get to observe AGMs. Like I say, it's very important to pay attention to the people running your money. They call it the principal agent thing, Yeah. So you need to look at whether they are emotional people. Let me give you an example. I didn't attend the AGM for Nobel Group. Nobel Group was this company that was exposed for fraud. Okay, so when it was being short sold by a group, the stock price fall, and what the owner did is during the episode, it bought a lot of stock. So if you were like me, and let's say if I were living overseas and have no contact with anybody who knows the owner or seen how the owner act, I would have bought stock, because buying stocks with your own money is a very strong action. I would have lost a lot of money. So it's a tremendous advantage to attend AGMs. You get to see, you get to observe. These are not things available to me when I invest in Hong Kong stocks. Yeah. I think that's all.
Can fly over. Okay. Next one. Thoughts on AI technology. I think we have circled back here.
Yeah.
On AI stuff. Thoughts on
Yeah.
AI technology and whether it will become the next big boom.
Um, it will go up a lot. It will become hype stock. I think Charlie Munger said something about that in his DJCO AGM. Most things in vogue, most things that become fashion stocks, means like, for example, AI and all that, they truly had a purpose. There's a real practical use for it, but you need to separate that purpose from stock price valuation. Okay, and most of the time they go up too high. But for example, let's say Microsoft bought ChatGPT, right? So how much would ChatGPT bring to Microsoft? You wouldn't know, but we know that Microsoft had a history of acquiring companies at overly high prices. MS bought OpenAI at 10 billion, I think, but that doesn't really mean that the price is sound. Microsoft bidded for Yahoo for $45 billion back then in 2008 or 9. The thing is, right, Michael Jordan might be the greatest basketball player in the world, but you can only pay a certain amount of salary for him. Anything beyond a certain number doesn't make sense. AI tech will bring about a bubble. I do agree. So you need to do valuation and act reasonable. Act reasonably. Don't chase. You lose money in the end. We've seen that happen for Zoom. We've seen that happen for Pfizer, Moderna, all the growth companies. They are truly truly destructive to a lot of people's net worth. This question.
Do you do merger arbitrage?
No, I only do simple going private transaction. When people say merger arbitrage, right, they actually mean something very complicated. They don't say, oh, I in exchange for company A stock, right? Company B will give you warrants and bonds and certain amount of bonds and all that. I know that's sophisticated. I do the simple stuff. Yeah. This question.
Say if you have 7 figures as of now, would you still invest in US or just buy boring SG dividend paying companies?
I'm a very lucky person. I don't live an expensive life. Some people, they cannot do that because maybe they got a very demanding spouse or they have parents depending on them. So I'm very lucky. I don't need $1 million to go into what they call a cruising fire. Okay, but I probably, because of my mindset, I never like buying dividend stocks. There's a saying by Buffett that you should not try to get rich twice. Means in order to get richer, right, you invest a lot of your net worth into something, and then you end up losing that. So, but between buying exciting and overpriced United States stocks and boring Singapore stocks, I'd rather buy Singapore stocks.
Reason?
I think it ties down to the next question.
Okay, I'll read out the next questions. Is it fair to say that dividends are issued by companies which have limited growth avenues to deploy their cash in? If so, does that diminish the appeal?
So the thing is, right, you need to look at the long-term track record of the cash flow of the company. And let's say if the dividend is paying out about 90%, means let's say the company could get a cash flow of about 10 million and the dividend payout is about 9 million. So the company is actually paying quite close to what they can earn. And if you're not careful, right, it's just take one problem for the company to get into some kind of issue and then they couldn't pay a dividend and you end up with a lot of capital loss. Because most of the time when we look at stocks in Singapore that are very well known for paying dividends, right, they are valued based on the dividend they are paying out. The moment they can't pay that dividend, right, all hell's break loose and you lose a lot of money. I don't like that. I'd rather buy a company that has a lot of room to grow their dividends, means they are not paying through their nose for the dividend. And most of the time, the yield is very modest, probably 3 to 4% at most. And there's 2 ways to look at things. You can look at it from the earnings front, means their cash flow is really more than sufficient to pay the dividends. Or you could look at it from a balance sheet perspective, means they have a lot of cash. But that one is actually more risky to me. Okay, so it's better to look at long-term cash flow. So let's deviate and talk about Perfect Shape. Perfect Shape was earning a lot of cash and its dividends are not bad, but it doesn't mean they are paying through their nose for them. They actually earn a lot of cash. So in terms of safety in dividends, Perfect Shape is quite okay that time. Okay in the past. Not now, maybe not now, and maybe not in the future. But that was how I look at it. Yeah.
Is there a dividend payout ratio that you target for? Like
no. Because most of the time, right, it's very rare to find this kind of companies where they are very easy. The dividends payout ratio is not too demanding. Most of the time when the dividend yield is very high, right, you'll find that they actually paying a lot of their earnings. And I don't like it. I like problems. Like for example, a company could cut dividend, right? That's actually very attractive to me because the dividend can be reinstated one day and you get the capital gains. But if you can accept the kind of dividends you get when the dividend is being cut, and you know that the reasons for them cutting the dividend is likely temporarily, then it's a good idea to buy some. But I don't like the kind of companies that were paying, like for example, StarHub in the past was paying 5 to 6%. And then if you look at the earnings, it was paying actually way more than they earned. And it would stop one day and it did. And then it was a $4, $3 stock. Today is $1.12. Yeah. How much do you lose? No point.
Okay.
Yeah.
We'll go a bit fast. Let's say if you don't want to comment too much, you can just let me know. Just skip.
Yeah.
We close the call in like 5 to 10 minutes. Okay. I'll state the next questions. Do you think 2023 will be a bad year for stocks and the global economy?
Yes. Every year I have problems. Every year we have problems. I think if you ask ChatGPT, right, what happened in what's the bad thing that happened in 2020, 2019, 2018, you'll find something bad every year. Don't look for problems, look for opportunities.
Wow.
Let the market bring the opportunity to you. Okay, don't think, hey, this is going to happen. Should I buy? Should I buy? No, you just wait and wait for opportunities. Don't worry too much. Yeah,
Sounds
there
good.
will always be a bad thing happening. Be optimistic that things will recover.
Okay. Your favorite stock?
Favorite stock, Xinghua Port. It taught me the most. The one TTJ also taught me a lot of lessons.
What about those that you can buy now, given today's price?
That would be stock recommendation. The thing is, I hesitate to give stock recommendation because I felt very responsible about people's losses.
Then we
When
skip.
you lose money, I get very upset. Yeah, next.
Okay. These two questions related to financial statement. When you read 10K and 10Q, I think this is like the annual reports.
Yeah.
Do you read them backwards from latest copy or forward from earliest copy? What is the main section that you read?
I read everything. I read every part of the but I don't really invest much in United States. So, but my approach for Hong Kong and Singapore is that I read everything. I will start off by reading the letters to shareholders by the CEO. I also read MDA, Management Discussion and Analysis. So you got a very quick sense of what they've been doing recently. So I read at least 5 years. And I will read almost everything except those accounting rules part. But really, if you are a financial fraud investigator, right, you will read those things first, because in order for you to justify showing certain figures in your financial reports, you need to change the rules first. So they will change the rules and then they will present the financial data. And you can look at the changes in the financial rules. For example, let's say the company might change the way they classify certain things as revenue. And they can put the number down as revenue. So that part is actually quite important in terms of investigating for fraud and all that. But I didn't read that because most of the time the companies I bought are not great. They are not in great shape already. So most of the time that is not a concern to me.
Okay. I think this one continuation, see what you want to add here. Which parts of the 10K do you pay most attention to? Which parts part of the 10K you pay least attention to? And how many years of past 10K you read?
I look at the financial statements. I look at the numbers first, and I look at everything lah. I'll compile all the figures manually by hand. I don't use data aggregators. I know if you look at Morningstar, you get all the numbers nicely formatted for you, but I don't do that. I look at the financial statements, the annual reports, and I manually key all of them into an Excel sheet and I look at them year to year. And I got to examine them on a very slow and romantic basis, so I can see certain figures very quickly, like how come suddenly the COGS, the cost of goods and services, go up so much, or how come the capex is so high that year. I will notice that. Yeah, I can go back and look at the annual report and look at the description based on the footnotes. Yeah, so I read everything actually.
Okay.
Yeah.
Sounds good. If asked you to pick your 3 favorite useful or investing book, what would it be? Also, which guru do you monitor? Bring it out.
Okay, I don't know whether you could see this. Yeah. The first book you should read is this. The 5 Rules for Successful.
Bring it higher. Yeah.
Yeah. I don't know because
now can.
Yeah, now you could, right? The 5 rules to successful stock investing. Because if you don't know anything about financial statements, this does a very good job in explaining to a layman. All right. The next thing you read is this.
The Bible.
Yeah, this is the Bible. You can see my one is quite an old copy, yellow. So sometimes when the stock market is not doing very well, right, I kind of like read this thing. It's really like a Bible to me. You could read this book many times and it's still entertaining because it's such a tough book for me. The third book, right? The third book is actually very split. Now, the third book, I got 3 options for you. Like course like that. 3 specializations. The first one is value investing from Graham to Buffett and beyond. There's 2 editions. The second, this one that I'm having here is the first edition. The second edition is actually tougher because it actually expounds on growth companies. This book does a very good job in telling you that you need to look at valuation through three kind of methods. First is balance sheet. He give you a very good example. You should read that one. Second one is based on no growth. Means the earnings is going to stay roughly this. How much should you buy? What kind of valuation what kind of valuation work do you do? Because when you look at earnings, right, even if the company is not growing, right, you need to take away all the very one-time earning deductions, like maybe legal fees. You also need to take away certain things like maybe discontinuing a certain kind of business. So sometimes a company can dispose a certain business operation and they take a gain from the profits from earning from selling that business operation, but that will be one time. So you need to take away that one. So this book basically talks about that. And the third part, which I don't really understand that well, is companies that had a moat. The other third book that I could recommend is You Can Be a Stock Market Genius by Joel Greenblatt. It talks about special situations. It's very easy to read, very entertaining. The last book, this one is super cheap. It's called Financial Statements and Analysis by Fritzton and Alvarez. What I have here is the third edition. There's a fourth edition. Basically, if you like financial statements, you read this. You probably don't need any other books after that. This is the must-read book for employees in this firm called Value Partners. It's a Hong Kong asset management firm. So the owner of that firm is a Malaysian.
From Penang.
Yeah, he was a journalist, no less. Very interesting story. I read his biography. Yeah. So I don't have a guru. I mean, there are a lot of people who are very, very smart. I think I cannot do the things they do. So I use very simple things. Yeah. This
so
question.
when talk about books, you people tend to think that these authors are very smart, right? Then come next questions which is related to YouTube channel. Whose YouTube channel do you follow that's good for investing? Because most out there are really lousy content and really waste time.
Sorry, Bunty, I don't watch YouTube. I don't watch YouTube. I don't watch much.
Wow, you want to avoid these questions?
I did watch the Backholders Pod. I did watch the Adam Khoo episode. I do watch some of the Mr. Lu thing. The Adam Khoo one is good. I like that one. But I don't really like to spend too much time with looking at YouTube videos. Yeah, especially those videos by Amor. Wow. Every one of them. The thing about YouTube is, right, you're looking at pre-packaged presentation. The content, the original content is financial statements. You choose not to read the financial statements. You choose to consume information of people's interpretation of the financial statements. So you're reading a subset of what you can have. And usually a YouTube video review, right? It's like telling you about a movie and what they like about the movie, but you might as well just go and watch the movie. It's like, you know, when management come out with stocks, when the company's management need to release earnings, they will also release something called a PowerPoint presentation slide, which is not really the entire earnings itself. And they will try to make the numbers look very good. Like, for example, they will say that, oh, our so-called interest coverage ratio is many times more. But then they will say, oh, then they'll put an asterisk down there and say this figure does not include perpetual securities. For those out there, it's just an accounting trick. Yeah, so they tend to make the numbers look good. So why not just go and look at the earnings release? Yeah, that's all I have.
Too dry sometimes.
Then don't invest. Don't invest. It's money.
No, invest in passive ETF.
Yeah. I mean, yes. A lot of people cannot beat the ETF.
Yeah,
a lot of people cannot beat the ETF. I cannot beat the ETF every year. You can go back to the video the earlier part, and you can see the figures. I don't do very well sometimes.
Okay. Next one. May I know if there? Okay, again. May I know, is there a similar website to ROIC.ai for Hong Kong stocks?
Yeah, I use Stock Cafe. It's a paid service. So I think RIC AI, I went to take a quick look, is basically data aggregator lah. So to tell you about the earnings and all that, what kind of returns they have over the years. I used Stock Cafe for many, many years. And without Stock Cafe, I could safely say I would never make so much from my investment. I own Stock Cafe a lot. Yeah, it helps me to screen for stocks. It tells me what kind of returns I'm having. Because I manage money for my mom and dad, which is not a lot, but it's still their money. So it helps for me to know what kind of stock I could have underbought. Means I could have too little of this stock for my mom or my dad. And sometimes I buy it for them or that. So I need Stock Cafe. Stock Cafe will do what RIC AI does. And maybe more, because Stock Cafe also show you dividend history and all that. Yeah, that's my answer.
Okay.
Yeah.
How do you read the contents of website that requires subscription like Bloomberg, Wall Street Journal?
I don't have Bloomberg. I don't have the Bloomberg, the news part. I don't have the Bloomberg terminal subscription, which cost like 5,000 back then. I only have Wall Street Journal. This is because I work in NTU, and NTU has a subscription to it, so I get to read it. Yeah, I'm very lucky. I'm a very lucky person.
Okay, I think the last two questions I'll group together, see what's your comment, then we close the call. Yeah. Okay. The first one, which broker do you use personally for your investment? And then the other one is, do you subscribe for any newspaper investing tools, investing materials? If yes, can recommend if they are useful?
Yeah. Like I said, I use Stock Cafe. Stock Cafe is about $30 per year. But there's actually one right now. There's an offer for you if you sign up for Webull, you put certain amount of money in it, you get free for 2 years. Trust me, it's worth it. Even without having to sign up for all these things. I use Stock Cafe. I saw the broker I use, he's somebody we all know lah. So he's from CIMB, and he does value investing as well. So from time to time he gives me very, very good ideas. So I tend to stay loyal to him. But sometimes the brokerage fee quite high lah, huh? So I did use Tiger Trade lah, huh? Sorry, but he's a great person. He understood.
Okay.
Yeah.
So for Webull, I don't have a referral link. Let's just say if you have or any of your friend have, feel free to let me know. Then we can put at the description so that can ease people to sign up for that brokerage. To get the Stock Cafe, I don't know. I think may be useful for some.
Yeah,
okay. I think you have to reward those who watch this 2 hours episode until the end. You put something there so that you can say, okay, I actually have a link for those who want.
Oh, okay. The thing is, right, a lot of you actually ask a lot of questions. There are questions where I'm not qualified to answer them because I don't think my answers are comprehensive. I don't have anything more than the normal literature you get out there to add. But I did answer all of them, and eventually we will put up a text file for all the questions. Yeah, even those that I could not answer. So if you know that if you post a question and it's not answered here, it will be there in the end in the text file. Yeah.
Okay, I think we are like long sessions. I said already, like long sessions, I don't have to talk, right? I'm free and easy only, but I think it's a lot harder for you have to talk for 2 hours. Okay, we should close the call now. Thank you so much to Boonsong for like sharing like very in-depth like sharing your experience and your knowledge in this field. Yeah, let's keep promoting value investing.
The thing is, if everybody does value investing, it will not work. But
only small set of people will do that. Yeah. It's not easy. Require a lot of energy also.
Emotional taxing.
Yeah.
Emotional taxing. Yeah.
Okay. Any closing statement?
Not really. I mean, just invest safely. Don't try to buy too much hype stuff. The thing is that there's a way to invest in a very simple manner, but within my approach, there's also difficulties, as you could see. I can't put it sufficiently in words. I mean, in a lot of things in life, right, it helps if you are early. If you are early in a lot of things, some problems are not problems. If you had been investing early, in your early 20s, you buy into index funds in a dollar cost average manner, you do very, very, very well. I cannot understate this advantage. Not only do you buy index funds And you don't even need to worry about how it does. In the intelligent investor, there's a phrase. It's called I don't care and I don't know and I don't care how it does. So if you buy index funds for 20, 30 years, you do very, very okay. And a lot of people, and you might, I hope not, but at the end of 20 years, the people who might not do better than index funds, I might not do better, you know, for all the effort and worries that I put in, I might not do better than the index funds. But if you are early and you invest early, you got a lot of things going for you. The probability is way better and you don't need to worry. So just buy index funds.
Thanks for sharing the advice. Let's say hopefully we will have more session in the future. Thanks a lot to watching. I'll close the call here. Thank you. Bye bye.